Okay, hello and good evening everyone. Welcome to DHTRADER.com. Now, you might have seen us on our DHTRADER.com eToro website. The purpose of this video is basically to explain how we trade, well, basically what we do, and the strategy that we use in order to do it. Now, at DHTRADER.com, what we work on is basically the laws of probability. What we want to do is determine them and profit from these laws. Now, as you can see on your screen right now, what we do is the purpose of DHTRADER.com is to show you what works and what doesn't. There are many strategies out there, many indicators out there that even though you follow them and you do exactly what they tell you to do, it will simply not work. And at the same time, some will. So this is what we do. Education wise, well, we've got a section on our website. We'll be developing it during the next few months or so in order to teach you how to trade and how to become successful when trading. And then finally, at DHTRADER.com, we trade. This is what we do. It's our full-time job. We are traders. What we teach you is what we do, and therefore, if it didn't work, then we wouldn't be here. Now, talking about the laws of probability, as you can see on your screen right now, I've got a very simple question to ask. If the purpose of this, and if what you want to do is land on the red square to win on these casino rolls, what would you do? Which wheel would you play? If you want to land on red, would you play on the left wheel or would you play on the right wheel? Well, this is a no-brainer. You definitely play on the right wheel where you've got most reds. Now, this is basically the purpose of the probability. You want to basically find the best option, the best probable situation in order for you to make money. Now, as Gary Befield said, investing or trading is like poker. You should only play the good hands and drop out of the poor hands. Now, this is where the stop loss comes in. Most of you will have known these words: stop loss, take profit. You always set a stop loss when you enter a trade, which will limit the loss that you are prepared to take. Take profit, which will not necessarily limit your profit, but basically set the level at which you determine that a trade is good to be closed, and take your profits on it. Now, talking about the laws of probability, if you have a look at the screen right now, you've got three situations. Now, situation A is the phone ringing while you're in the bath. Situation B, your teacher falls ill when you're at school and cancels a test that you'd been dreading. And then finally, situation C, being struck by lightning twice. Now, when we talk about laws of probability, we talk about sigma events. Now, situation A, phone ringing while you're in the bath. I'm sure that most of you watching this video, this is something that has actually happened to you. We therefore call it a 1 sigma event. It's basically a 1 in 3 probability that it would happen. Now, your teacher falling ill and cancelling a test you'd been dreading. Has it happened to you? Possibly. It's never happened to me, but nevertheless, this is what we call a 2 sigma event. It's basically a 1 in 20. It's unlikely, but it's possible. It can happen. Finally, C, being struck by lightning twice. Well, I'm pretty sure that you wouldn't know someone who's been struck by lightning twice, but then again, it is a possibility. Nevertheless, we call this a 5 sigma event, which is a 1 in 1.74 million situation probability that a situation would happen. So, I mean, this is basically telling you what something is likely to happen, or if it's not likely to happen. Now, I was a bit concerned, and not really concerned, but hesitating whether to put this or not, but I think it's a perfect example to describe the laws of probability. If I was to tell to you what is the probability of two planes crashing in less than 4 months of each other pertaining to a same airline, I'm sure you would have said, well, it's highly unlikely. Well, yes, this is a 5 sigma event. I'm referring obviously to the two Malaysia airline planes that crashed in less than 4 months of each other. 5 sigma events, we're looking at a 1 in 1.74 million probability of it happening. If we look at a frequency for this on a daily event, then it's something that could happen once every 4,776 years approximately. Something that a lot of people will not live to see. Fortunately, we did. Now, what we do basically is we try and determine through the laws of probability if an asset is either undervalued or overvalued. Now, I don't know whether some of you watching this video out here right now have bought a new car this year or the previous year, but my question is to you would be this: if you have bought a car, if you're thinking of buying a car, what would you do? Would you buy a car that is overvalued, fairly valued, or undervalued? Well, I think the question here is basically clear, just like the casino wheel question, where you would buy a car that is undervalued. And if it's extremely undervalued, well, it's better still, isn't it? Let's take the example of, for example, the Porsche. You want to buy a Porsche. A Porsche is valued at 50,000 US dollars. You find a second-hand one with just 10,000 miles on the clock. Well, you say to yourself, good car. Its value is approximately 40,000 US dollars. And the owner of that car will say to you, well, for XYZ reason, I need the money, etc. You can have it for $15,000. Now, he's given you an extremely undervalued price for that car. Now, $15,000 on something that would be worth $40,000, I'm pretty sure that all of you out there would go out and buy the car. So this is what the purpose of trading is. We're trying to determine the right price, see whether we can find a bargain, and basically either it being overvalued or undervalued. If it's overvalued, we would sell, short. If it's undervalued, we would buy, and then when it reaches its fair value, we would close the position. Now, if I was to ask to you, how likely is it for the price of a car, for example that Porsche, if it's valued at a fair value of $40,000 to be sold at $15,000? Now, this is extremely rare. You would really rarely see someone offering that car at that price when he knows that the fair value is 40,000. Well, this happens approximately, if we were to put a percentage on this, it happens less than 4.5% of the time. But it does happen, and when it happens, you have a huge opportunity, an opportunity that you should not miss. You should buy that car at that price, or any asset at that price, and sell it when it reaches its fair value. Or if we're in the shorting strategy, then we'll be looking for something that's definitely in an extreme overvalued situation in order to short it and then close a position or buy when it reaches its fair value. Now, this is what investing is all about. The principle of investing is you buy when an asset, either stock, property, commodity, indice, is undervalued or at a discounted price. You sell or take profits when the asset becomes fair or overvalued. Now, the reverse applies when you're shorting. Now, how do you know? This is a question that I'm sure all of you will be making or asking now. How do you know when a market is over or undervalued? Now, how to see an opportunity when others don't? What is the key feature of our trading? What we'll be trying to do and what we're constantly trying to determine is determining the value of an asset. Is it fair value, overvalued, or undervalued? Now, our combination of indicators will measure probability, i.e. probability of an asset losing value or increasing in value, and we'll also be measuring the value. Now, our indicators are not oscillators. We're not using RSI. We're not using MACD. All these are oscillators and will actually give you an shall we say, overbought or underbought situation. Now, our indicators do not do that at all. Now, what we do basically is we find the adequate sigma zone. If you remember the three situation I gave to you previously, A, being in your bath when the phone rings, B, an exam being cancelled by the teacher, an exam that you'd be dreading, or C, being struck by lightning twice. All these were sigma events, like one sigma event is 1 in 3, a 2 sigma event basically 1 in 20, and then the 5 sigma event 1 in 1.74 million. Now, this is what we can actually see on our charts. As you can see on the screen now, we've got a red zone at the top here. This red zone determines the extreme sigma zone, which is extremely overvalued. Just under that, you've got the moderate sigma zone, which is moderately undervalued. The blue zone of a chart is telling you that it's a safe sigma zone, is the fair value of a price. And then underneath this, we go into the moderately undervalued sigma zone and the extremely undervalued sigma zone. Now, the law number one of probability is that a market has very low tolerance for moves into the extreme sigma zone. This means that price does not stay in an extreme sigma zone for very long. If we go back to the previous chart, if we're at the top here, if you just have a look at this chart here, how many times has the course of the asset gone into either the upper red zone or the lower red zone? Well, as you can see, it hasn't gone too often, according to all the bars that you've got there, and every time it has, it's always fine in the following bars. Its fair value, either entering the higher extreme zone, then it would go back down, or if it goes into the lower extreme zone, then it goes back up, finding its fair value. Now what we're going to do now is have a look at some examples for you to see this on the chart. Let's see, for example, I'm going to put the DAX chart on for you. You'll be able to determine here. Well, let's have a look. What you've got on the screen right now is the DAX. We'll zoom in a little bit for you to see. Now if I say to you, well, there we are, this is a DAX chart, what would you do? We're at a value now of 96.39. Would you buy? Would you sell? Well, this doesn't say much to you, does it? And this is basically what we look at when we see a chart with no indicators. Now, 90% of traders out there who are basically trying to make money haven't got a clue of what they're doing. They don't know whether they should buy, they don't know whether they should sell. They're looking for fundamental analysis. They're waiting to see whether something's going to develop, putting upwards pressure on the DAX or putting downwards pressure on the DAX. That can work, possibly 2 sigma event. It could work 1 in 20, but most of the time, this is like a casino, the house will win. Now, as you can see, this is the ordinary chart without our indicators on it, and I'm going to put now on your screen the same chart with our indicator on. Now basically what you can see here is the same DAX chart with the extremely overvalued, moderately overvalued, the fair zone, which is the blue, and then we go back down to the moderately undervalued and extremely undervalued. Now if we go back in time, just here for example, on the 12th of September, which was 2 days ago, at 1 p.m. we entered the undervalued extreme sigma zone. This was at the 96.16 level. At this point we entered a long position on the DAX, and what happened in the following hour? Well, we went back up to its center line of the extreme value of 96.58. So basically here we've had a 40 tick profit in the space of 1 hour. What we have to do, just go back a bit, just here we didn't quite enter it, but this is enough to, especially on the DAX, as we have identified it, we're now in a downwards trend. We just under the extreme overvalued, we were in the moderately overvalued, entering the extreme. We took a short position at 97.20 on the DAX. In the following hour we went back down to its center line of 96.85. So once again here we've got a 35 tick profit, which was just about 3 hours previous to our 40 tick profit on the DAX, entering different positions. Let's go back down here. At on the 11th of September at 8 a.m. we entered the extremely undervalued sigma zone, 96.70. The following hour we immediately went back to its fair value of 97.60. Let's go back. As you can see, once again here we've got a trade, entered the extreme sigma zone, undervalued sigma zone on 96.35, went back up to its fair value in the following hour of 96.80. Once again we've got a definite profit here, and as you can see, every time we've entered the extreme either overvalued or undervalued zone, we have gone back to its fair value. Now this works, our strategy works 90% of the time. It is true there are situations where it won't work, and I'll show you one just now. For example, here we've got a situation on the 4th of September. We entered the extreme overvalued sigma zone. We took a short position at 96.74. Now our stop loss is always just above the closure of the sigma zone. In this case would have been 97.04. On the following candle, well, it's not a candle, it's the bar basically, we did not re-enter the fair value, so we would have kept our position open, and what happened, we went back up into the extreme oversold sigma zone, taking us to our stop loss and basically kicking us out of the market. So it is true. I'm showing you the transparency of our method. We haven't got 100% foolproof method with 100% ratio of win. I think that this doesn't exist at all. There are extremes in the market which will basically kick you out. This was the case here, but we do have a 90% ratio of wins on our trades based on the Sigma method, as you can see on the charts, the screen right now. So basically this is a description of what we do. I thought it was important for you to see how we trade, how we do it. When we trade, we've got certain key features that we look at. We basically look at key information. We want to know how likely a market move is. If we're in an extremely overbought zone, then it's extremely likely for the market to go back to its fair value and either go down. If it's the other way around, if we're in an extremely undervalued zone, then it's highly likely for the market to go back up to its fair value. So what we're trying to determine is when the market is most strong, and we use it at our advantage. The value is something that we want to determine too. We want to discover quickly whether a market is extremely overvalued or undervalued. Normal charts, as I showed you previously, does not tell you this. We've got a strategy. We find high probability opportunities to trade the market. We trade the news, NFP, non-farm payrolls, etc. We do long-term trades and short-term trades, especially when we trade news. They're basically short-term trades. We'll make the best profits in the space of certain minutes. And then finally, we want to set the exact target. So when we take a position, either long or short, we want to know when is the exact and perfect time to exit our position. Now, if we're taking a long position when the market is extremely undervalued, then a moderately overvalued or fair value is a good time to close our position. This is what we do. We trade cautiously, so when we reach the fair value, we close usually 50% of our position. We maintain 50% open in order to close it should we reach the extremely overvalued or moderately overvalued situation. This is what we do. Please do not hesitate to contact us if you have any questions regarding to our strategy. We'll be more than happy to help and to answer any questions. You can do so by answering us on our eToro website, or you can actually contact us on Facebook at DHTRADER, or on our website DHTRADER.com. I hope this helps, and please do not hesitate to contact us if you have any questions. Bye for now.